Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to U.S. Markets Wrap with me, Ryan Huang. So we've got record highs again on Wall Street. The S&P 500 rose 0.5%. And also a record high for the Nasdaq Composite after a rally of 0.9%. The 30-stock Dow, on the other hand, was underwater by 0.02%, or pretty much flat there. And that's following some movements on the trade front, an announcement from President Donald Trump on Truth Social that the U.S. had struck a trade deal with Vietnam, which includes a 20% tariff on imports from the country. Also in the mix, some jobs data, and that's where you have the ADP numbers coming through. The private sector hiring decreased by 33,000 last month. Now let's unpack it all with Steve Sosnick. He is the Chief Strategist for Interactive Brokers. Steve, thanks for joining us on the show. How are you doing?
Doing great, Ryan. Good morning to you.
Yeah, it's a great week. We've got record highs yet again on Wall Street. Walk us through what you're taking away from the market action. Is this what we're seeing typically in July?
Really, I mean, there's two schools of thought. There's the summer swoon or the summer rally. I mean, certainly we seem to be continuing the rally that's been going on most of the spring. I think right now we're being driven mostly by momentum because stocks are going up because they're going up. And I know that sounds very simplistic, but it is a big motivator. And fear of missing out. Nobody wants to miss a rally. So I've been calling this MOMO and FOMO as the shorthand to describe the rally. And, any piece of news that's not horrible is enough of an excuse for the market to move higher.
Yeah, I suppose in some sense there hasn't been a lot going on relative to prior weeks, prior months. So not a lot to trade on or to work around. What are you looking out for when you are perhaps looking at the non-farm payrolls data coming through in the later part of this week?
Well, that's tomorrow morning our time. So they're earlier than normal because here it's a short week. We have off for July 4th, Independence Day, and we actually have a half a day tomorrow. So it's actually only a 3.5-day trading week this week. But before we get to call it quits early, we do get the non-farm payrolls and unemployment figures tomorrow morning. 110,000 new non-farm payrolls is the consensus estimate. We see that basically, in various economist estimates. We also have a forecast. We also have our forecast contracts that we trade, and that's about where they come in now on those. And the unemployment rate is expected to tick up to 4.3% from 4.2%. It leaves us in an interesting situation because the market, we've got very conflicting stories about labor this week. We got a bigger than expected JOLTS job openings number, meaning there are more jobs available than were expected. That was Tuesday. And then today we got ADP declining. Neither is a perfect predictor, but I think, remember, the Fed's dual mandate is stable prices and full employment. And, here we find ourselves with the Fed still at numbers that are, even if it's 110 and 4.3, which is relatively weaker than where we've been, that's still pretty good. And I think they're still more concerned about inflation coming from tariffs than they are about a truly weak job market.
Yeah, I'm also looking at news around jobs coming through from the likes of Microsoft. The latest is Microsoft laying off about 9,000 employees. It looks like we are still seeing job cuts among the big tech companies. What should we be taking away from some of these movements?
I think the idea, we saw a lot of what economists were calling labor hoarding in the post-COVID run-up, when the economy was screaming ahead. And I think, companies just got people on board just because they did not want to be short of people. In Microsoft's case, it's kind of interesting because, this could actually be the beginning of AI effect at some level, right? Because we could be starting to see, maybe you don't need quite as many people to just write basic code if you've got AI to do it for you. So it's interesting because you don't expect to see a company that is continually making new highs and continually, making more and more money each quarter, having the need for massive layoffs. And I would say 9,000 is a pretty big number by any standard. But yet, when we look at that, this is a market in flux. And, you also have the government in flux where you had the big layoffs as the result of Elon Musk's Doge, and then most of them got wiped out by the courts, and it turns out they fired people they shouldn't have. So there's a lot of moving parts right now in the labor market, and I think that's another one of those areas. That's another reason why the Fed might be reluctant to be too aggressive in one direction or the other.
All right, just to give a bit more color around Microsoft, they're looking to reduce the number of layers of managers that stand between individual contributors and top executives, according to some reports. All right, taking a look at what you mentioned just now, Doge, and of course that involves or used to Elon Musk. Where do you sit right now with Tesla? They are facing quite a bit of competition on the global front, especially from China. Is this a good time now that he's got more focus or more time on his plate?
In theory, that's kind of the bet they're making. But then again, he seems to be unable to not antagonize the president. I mean, yesterday we saw the stock fall dramatically. It was trading below $300 a share for a little bit, and that's down considerably from the enthusiasm about the robo-taxi launch in Austin, Texas. But then today, the sales numbers were worse than expected and the stock rallied. So Tesla is sort of in its own little world. It has a very, very faithful group of shareholders. Over the past week at our firm, we saw it being the stock with the most net buying, even as it was declining pretty much every day last week. So that could have been very comfortable for those people yesterday, but probably worked out for many of them today. It's just its own strange animal. It moves on different things than everybody else. As a car company, the valuation is truly astronomical, but you're not buying the car. You're not buying it as a car company. You're buying it as a bet on the future. And of course, there are very mixed opinions as to whether that futurism is being overpriced or not. We could spend an hour debating robots and robo-taxis and all the other stuff. But strictly in terms of being a car manufacturer, which is what it is in the present, it is valued way more aggressively than companies like Toyota or Ford or General Motors, et cetera.
Yeah, lots of ways to look at Tesla. Let's take a look at the big beautiful bill. So that's coming through or going through Congress. What's the takeaway here? Is this good for markets in the long run?
It should be, in the sense that, it is attempting to reduce government spending and attempting to reduce some regulation. In reality, I'm going to leave that up to the bond market, which really hasn't voted yet. The problem being is, no matter how we slice it, it seems that it's going to increase the deficit. Maybe not right away, but over the course of time. And now, for as long as I've been in the business, bond traders have been nervous about rising deficits and the ability, and people's willingness to keep buying our debt. That's been going on for decades. So will that change now? I don't know. What I'm watching for is, do we start to see the 10-year yields rise much more aggressively than we see shorter-term rates? That's called the steepening yield curve. The 10-year yield goes up faster at the shorter end. So you're in a situation where you might get rate cuts. That's what the market's pricing in, is at least 1 to 2 rate cuts for the rest of the year. But on the other hand, if the market is concerned that over the long run, this is going to give the U.S. problems in refinancing its debt or being forced to allow some extra inflation in order to pay back the loans in nominal terms, that's my concern. We're not seeing it yet. We saw it a little bit today, but only a couple of basis points. I don't know that that's the case. But I do think it's not a popular bill in the U.S., but it feels, and to a lot of people, it feels like it's being rammed through. But I think the real vote is going to come from the bond world and international bond investors particularly.
Yep. What will be the price of the sweeping tax reforms? We'll find out in time to come. And helping us out this morning is Steve Sosnick. He is the Chief Strategist for Interactive Brokers. Steve, thanks for the time and always great chatting with you. Thanks again for all your insights.
Thanks, Ryan. My pleasure as always. I hope to talk again soon.
All right. Catch you next time. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.